If you want to leverage your capital and increase your potential returns, you might want to consider trading margin options. Margin options are options that require a margin deposit from the seller or writer of the option. In this lecture, we will explain the basics of margin options, their advantages and disadvantages, and how to trade them safely and effectively. What are margin options? Margin options are a type of financial derivative that allows investors to profit from changes in the price of an underlying asset without owning the asset itself. An option contract gives the holder the right, but not the obligation, to buy or sell the underlying asset at a predetermined price, called the strike price, before a specified expiration date. The two main types of margin options are call options and put options. A call option gives the holder the right to buy the underlying asset at the strike price, while a put option gives the holder the right to sell the underlying asset at the strike price. When trading margin options, investors must pay a premium, which is the price of the option contract. The premium is determined by several factors, including the current market price of the underlying asset, the strike price, the time remaining until expiration, and the volatility of the asset's price. Some examples of margin options are SPAN margin options. These are options that use a risk-based margining system called Standard Portfolio Analysis of Risk, SPAN, developed by CME Group. SPAN calculates the worst-case scenario loss for a portfolio of futures and options based on various factors such as price changes, volatility changes, and time decay. Portfolio margin options. Portfolio margin options allow traders to reduce their margin requirements by taking into account the diversification and hedging effects of their portfolio. Portfolio margin options are only available for qualified investors who meet certain criteria, such as having a minimum account balance of $100,000 and passing a suitability test. Cross-margin options. These are options that allow traders to use the same margin account for both futures and options contracts. Cross-margin options enable traders to offset their positions and reduce their margin requirements by taking advantage of the correlation between futures and options markets. Advantages and disadvantages of margin options. Trading margin options can have several advantages and disadvantages compared to trading regular options. Some of them are: advantages, leverage. Margin options allow traders to control a larger amount of underlying asset with a smaller amount of capital. This can magnify their potential returns if the market moves in their favor. Flexibility. Margin options offer traders a variety of strategies and combinations to suit their risk-reward preferences and market outlooks. Traders can use margin options to speculate on price movements, hedge their existing positions, or generate income from premiums. Liquidity. Margin options are usually traded on liquid and regulated exchanges or platforms, which provide transparent pricing, efficient execution, and low transaction costs. Disadvantages. Risk. Margin options carry more risks than regular options for the option seller because they require a higher margin deposit and expose them to unlimited losses if the market moves against them. If the option sellers fail to meet their margin obligations, they may face a margin call requiring them to deposit more funds or liquidate their positions at unfavorable prices. Complexity. Margin options involve complex calculations and rules that vary depending on the type of option, the underlying asset, and the exchange or broker. Traders need to understand how margin requirements are determined, how they change over time, and how they affect their profitability and risk exposure. Volatility. Margin options are sensitive to changes in volatility, which can affect their prices and margins significantly. Volatility can increase or decrease unexpectedly due to various factors such as news events, earnings reports, or market sentiment. How to trade margin options safely and effectively. Trading margin options can be rewarding but also challenging. Here are some tips on how to trade margin options safely and effectively. Understand the basics of margin options, such as the types of options, the margin requirements, the expiration dates, and the risks and rewards involved. Choose a reputable broker that offers margin options trading and open a margin account with them. You will need to deposit some funds as collateral and agree to the terms and conditions of the margin agreement. Conduct thorough research and analysis on the underlying asset and the market conditions before entering a margin options trade. You should have a clear trading plan and strategy and set realistic goals and limits for your trades. Monitor your margin options positions closely and regularly, and be prepared to adjust or exit them as needed. You should also keep track of your margin balance and maintenance margin, and avoid getting a margin call or liquidation. Manage your risk exposure and diversify your portfolio. You should never invest more than you can afford to lose, and use risk management tools such as stop-loss orders, hedging strategies, and position sizing. Thank you for your attention and participation in this course on margin options. If you have any questions or feedback, please feel free to contact us at the email address shown on the screen. Wish you all the best in your future trading endeavors.